We often drown in a sea of numbers: earnings per share, price to earnings ratios, debt to equity. We meticulously crunch these figures, believing they hold the keys to investment success. It's a natural inclination, this focus on the tangible, the quantifiable. After all, numbers are precise, objective, and readily available. They form the bedrock of what we commonly call financial analysis. But what if I told you that the most profound indicators of lasting value, the true engines of sustainable wealth, often lie beyond the spreadsheets and financial statements? What if the real secret sauce, the one that separates the truly exceptional investors from the rest of the pack, is something you can't easily put a number on? Benjamin Graham, the father of value investing, understood this deeply. He spoke of a margin of safety, a buffer against the unpredictable nature of markets and businesses. While he often applied this to the price of a stock, the principle extends far beyond mere valuation. It's about understanding the business itself, its inherent strengths, its resilience. It's about looking at the qualitative, the intangible, the aspects that often get overlooked in the rush to analyze the quantitative. This is where the real edge lies. This is where seasoned investors, the ones who consistently build and preserve wealth over decades, focus their attention. They don't just skim the surface of financial reports. They delve deeper, seeking to understand the soul of the enterprise. They look for qualities that, while harder to measure, are far more predictive of long-term success. In this exploration, we will begin to shift our analytical lens. We will move beyond the simple arithmetic and focus on discerning the deeper, more resilient strengths that drive enduring business success. We will uncover the three critical qualitative metrics that top investors scrutinize, often before they even glance at the financial statements. Prepare to understand why these unquantifiable aspects are not just important, but absolutely essential for building truly sustainable wealth. Our first critical metric, the bedrock of enduring investment, is the economic moat. This isn't just a catchy metaphor. It's the fundamental shield that protects a company's profitability from the relentless siege of competition. Think of it as the qualitative defense system of a business, analogous to the moats, walls, and strategic positioning of a medieval castle. These aren't physical barriers, but dynamic shields that safeguard its kingdom, its market share, and profits. A true moat can manifest in several forms. There are the powerful network effects, where a product or service becomes more valuable as more people use it, like a social platform or a marketplace. Then come intangible assets, the patents that protect innovation, the brand recognition that commands loyalty and pricing power, or the proprietary technology that rivals cannot easily replicate. Cost advantages, too, can form a moat, allowing a company to produce goods or services at a lower cost than competitors, thereby offering better value or achieving higher margins. Finally, switching costs. The inherent difficulty or expense for a customer to move to a competitor can create a sticky customer base that insulates a business. Some might argue that a strong brand is meaningless without a superior product. This is a common misconception. A powerful brand is often the visible outcome of deeply ingrained qualitative strengths, customer trust, consistent delivery of value, and a perceived superiority that transcends mere specifications. These are the intangible assets that allow a company to command a premium, to weather economic downturns, and to maintain its profitability. We must learn to look for the tangible evidence of these intangible advantages to see how they are woven into the fabric of the business. The true test of a moat, however, is not its mere existence, but its durability. Is it a shallow ditch that can be easily crossed, or is it a formidable, deep chasm designed to protect the kingdom for decades to come? We must observe management's strategic decisions, listen to customer feedback, analyze competitor actions, and track industry trends to discern whether a moat is widening, strengthening, or beginning to erode. Is the company actively reinforcing its defenses, or is it allowing the walls to crumble? This is the deeper question that separates astute investors from those merely looking at the numbers. Our second crucial qualitative metric focuses on the capital allocation maestro, the leadership's ability to deploy resources with exceptional skill. This goes far beyond simply having good management. It's about scrutinizing their actions, how effectively they channel capital into growth initiatives, reward shareholders, and drive operational excellence. We'll look at their decisions regarding research and development, strategic acquisitions, share buyback programs, and dividend policies. Are these decisions consistently creating value, or are they merely shuffling assets? Think of a company's leadership as the conductor of a magnificent orchestra. The musicians represent the company's assets, its employees, its intellectual property. The conductor's skill lies in harmonizing their efforts, choosing the right tempo for the music, and interpreting the score in a way that produces a beautiful, cohesive performance. Similarly, a capital allocation maestro can take a company's resources and transform them into a symphony of growth and profitability. Here lies a hidden truth. Simply spending a lot on research and development doesn't automatically equate to innovation or success. Top investors look for effective and D, investments that consistently yield tangible, competitive products and services, not just vanity projects or research that leads nowhere. We can learn much by examining companies that have squandered vast sums on ill-conceived projects versus those that have meticulously multiplied their capital through astute investment in innovation. To gain an actionable insight, we must analyze a company's track record of capital allocation decisions over multiple business cycles. Look for consistent, value-creating choices and pay close attention to how management communicates these decisions. For instance, comparing the returns on invested capital ROIC of two similar companies over a 5 to 10 year period can reveal profound differences in their leaders' resourcefulness. A company might possess a brilliant product, but if its leaders are poor stewards of its resources, it's akin to a magnificent ship with a hidden leak destined to founder, no matter how strong its hull. Our third, and perhaps most elusive, qualitative metric is the culture of execution. This metric probes the very soul of a business, the intrinsic how behind its operations. It's about understanding its operational efficiency, the morale of its workforce, the quality of its customer service, and the underlying cultural DNA that drives consistent performance and, crucially, adaptability. How does the company respond when the winds of change blow, or when unexpected challenges arise? Consider a high-performance sports team. Beyond having incredibly skilled players, it's the team's chemistry, the quality of its coaching, its collective discipline, and its ability to execute complex plays under immense pressure that ultimately determine victory. This intangible yet vital culture of execution is precisely what discerning investors seek within a company. It's the invisible force that binds everything together and propels the business forward. There's a half-truth that suggests happy employees don't always translate to a profitable company. While it's true that sentiment alone isn't enough, top investors understand that a culture which fosters productivity, innovation, and deep customer loyalty is a direct, powerful link to the bottom line. We can observe leading indicators of this by examining metrics like employee turnover rates, customer satisfaction scores, and product quality. These aren't just numbers, they are reflections of the company's internal environment and its commitment to excellence. To gain an actionable insight, we must learn to assess this culture. We can look at employee reviews on platforms like Glassdoor, scrutinize customer service ratings, and examine product defect rates. Furthermore, observing how a company navigates market disruptions or responds to crises can reveal its true character. For instance, analyzing how a company like Costco cultivates a culture that demonstrably benefits both its employees and its customers provides a powerful case study. A strong culture isn't merely a feel-good factor. It's the invisible scaffolding that supports consistent execution and allows a business to not just survive, but truly thrive through the inevitable storms of the market. We've explored three critical qualitative metrics: the unshakable moat, the skillful capital allocation, and the robust culture of execution. Now, it's time to connect these dots to see how they don't exist in isolation, but rather intertwine to create a company's enduring value. These are not separate factors, they are deeply interconnected drivers of long-term success, each reinforcing the others. Imagine a healthy, thriving ecosystem. The strong, deep roots of a tree provide stability and anchor it firmly against the elements. This is akin to a formidable economic moat. The efficient flow of nutrients and water through the plant fuels its growth and vitality. This mirrors skillful capital allocation, turning resources into tangible progress. And the resilient structure of the plant itself, its ability to adapt to changing seasons and conditions, represents the culture of execution, allowing it to weather challenges and persist. All these elements are essential for sustained vitality. Understanding this synergy reveals a hidden risk in solely focusing on quantitative data. Companies with seemingly attractive financial statements, perhaps buoyed by temporary market conditions or a single successful product, can mask underlying weaknesses. A weak moat, coupled with a history of poor capital allocation decisions and a toxic internal culture, creates an inherently fragile business. When the inevitable market storms arrive, these companies, despite their superficial financial appeal, are far more susceptible to collapse. Overlooking these qualitative pillars is a systemic risk that seasoned investors diligently avoid. To empower your own analysis, consider developing a simplified framework. This could be a checklist or a scoring system that integrates these qualitative metrics alongside your quantitative assessment. This approach enables a more holistic evaluation of any business, moving beyond mere numbers to grasp its true underlying strength. The true art of investing, therefore, isn't just about reading the numbers. It's about understanding the narrative they tell and recognizing the intangible forces that are actively writing that story. Chapter after relentless chapter, we've journeyed through the landscape of qualitative analysis, exploring the vital metrics of the economic moat, capital allocation, and the culture of execution. Now, the crucial step is bridging the gap between this theoretical understanding and its practical application in your investment decisions. It's about moving from simply knowing asterisk what asterisk to look for to knowing asterisk how asterisk to apply these insights to identify truly exceptional opportunities and, just as importantly, to sidestep the pitfalls that ensnare so many. Think of learning to cook. You can meticulously read recipes, understanding the precise measurements and cooking times. This is your quantitative data, but true culinary mastery comes from understanding the subtle properties of each ingredient, the chef's intuitive techniques, and that indefinable feel as a dish begins to come together. This deeper understanding is your qualitative analysis. Without it, even the most precise recipe can lead to a disappointing meal. The danger of quantitative myopia is very real. An over-reliance on numbers alone can blind investors to the fundamentally weaker businesses masquerading as value plays. They might chase seemingly low P/E ratios or high dividend yields, only to discover that the underlying business lacks a durable moat, suffers from poor management, or is burdened by a toxic culture. In reality, these qualitative factors often become the ultimate determinants of success or failure, far outweighing the superficial appeal of the financials. So, how do we apply this practically? Begin by asking the right questions. When reviewing annual reports, particularly the 1OK filings, look beyond the financial statements. Read the management discussion and analysis section carefully. Listen to investor calls not just for the numbers, but for the tone, the clarity of vision, and the substance of the answers. Dive into industry analysis and competitor research. Ask, is this moat widening or narrowing? Is capital being allocated wisely for long-term growth? Does the culture seem to foster excellence and adaptability? Ultimately, the most robust investment decisions are forged where rigorous quantitative analysis meets profound qualitative understanding. This synthesis empowers you to see the forest asterisk and asterisk the individual, resilient trees. We've ventured beyond the familiar realm of spreadsheets and financial statements to uncover the profound, often overlooked, qualitative metrics that truly exceptional investors scrutinize. We've delved into the strength of a company's economic moat, its dynamic shield against competition. We've assessed the skill of its capital allocators, the maestros orchestrating its resources for growth. And we've gauged the robustness of its culture of execution, the invisible scaffolding that supports consistent performance and adaptability. These intangible factors, these unseen architects, are the bedrock of sustainable value. They provide a crucial layer of insight that quantitative data, while essential, simply cannot offer on its own. They are the undercurrents that explain why some companies, even when facing adversity, not only survive but thrive, while others, despite superficially attractive numbers, falter. As the sage of Omaha, Warren Buffett, often reminds us, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Our exploration today has been dedicated to illuminating precisely asterisk how asterisk to identify those wonderful companies. It's about looking past the immediate financial figures to understand the deeper, more resilient qualities that make a business truly special and enduring. By integrating these qualitative analyzers into your investment process, you are not merely adding another step. You are fundamentally transforming your approach. You equip yourself with a more discerning eye, capable of seeing the substance beneath the surface. You build a stronger defense against the inevitable volatility of the market, understanding that true strength lies not just in numbers, but in character. And most importantly, you carve out a clearer, more reliable path toward building wealth that is not just significant, but truly sustainable. What hidden qualitative strengths will you seek out next in your investment journey?